Ever tried trading crypto only to watch your transaction get stuck and someone else swoops into the profit from it? That's no accident. It's called Maximum Extractable Value or MEV, and it's transforming how we think about blockchain transactions, especially on Ethereum. In this video, I will break down what MEV is, how it happens, and how you can protect yourself from hidden fees, front-running bots, and more. Ready? Let's dive in. Hello, my name is Puneet. I make videos on tech, emerging tech to help you stay ahead, save time, and make smarter decisions. First up, MEV stands for Maximum Extractable Value. Originally, it was Minor Extractable Value because minor is proof of work. Could reorder transaction in a block to gain extra profit beyond normal block rewards and gas fees. But now that Ethereum has moved to proof of stake, we use Maximal. Since validators can do the same thing, think of MEV as an invisible tax on your trades. You send the transaction, maybe you are swapping tokens on a decentralized exchange and everything looks normal. But behind the scenes, bots or block producers can reorder the transaction queue to siphon profits from unsuspecting users. Sometime you will see it called front running, back running, or even sandwich attack. Don't worry, I will explain them all. Blockchains like Ethereum process transactions in blocks, but who decides the order of those transactions? That's up to the block producer. Previously, now validators who gather transactions from the memory pool, a public waiting area for all pending transactions. MEV searches are specialized bot scanning this mempool, looking for profit opportunities. For instance, if they see someone about to buy a large chunk of ETH on Uniswap, they will jump ahead of that trade by paying slightly higher gas fees. Why? Because once the big order hits, the token price goes up, allowing the bot to sell right away for a quick profit. That's the essence of front running. Sneak in before knowing the price of the move. You submit a trade, bot sees it in the mempool and pushes it to own transaction first by offering a higher tip to the validator. Result, the price shift and you end up paying more for your tokens and getting fewer tokens as expected. This is a reverse scenario. The bot sees a large trade, places its own transactions immediately after the trade to capitalize on the resulting price change. Probably the most infamous, the bot sandwiches your trade by buying the token first, front run, letting your trade move towards the price further, and then selling right away, back run. Your transaction is effectively squeezed in the middle, forcing you to pay higher price. Not all MEV are malicious. Arbitrage bots look for price differences according DEXs. This keeps price aligned, so ironically, it can help the market, but it still benefits those fast enough to execute the trade first. DeFi's leading protocols lets you borrow token against your collateral. If your collateral value drops, you can be liquidated. MEV bots race to find first to liquidate, earning a fees useful for protocol stability. But it can make borrowing riskier for everyday users. Why do we see so much MEV on Ethereum? Simple, Ethereum hosts biggest DeFi ecosystem with tons of DEX, lending markets, and NFT platforms. More actively means more opportunities to reorder transactions for profit. Even after EIP 1559, which changed Ethereum fee market and the switch of proof of stake, MEV hasn't vanished, it just evolved. Instead of miners, now validators and specialized researchers are making deals, sometimes off-chain, to capture MEV. MEV has serious downsides. Higher gas fees. When bots completes to front-run trades, they bid up transaction fees, making the whole network more expensive. Worse trade execution. Retail traders get stuck paying more or receiving fewer tokens thanks to sandwich attack. Validator centralizations. Large staking pools can invest in better infrastructure or private relays to capture MEV, concentrating power. Censorship risk. Some block producer uses private mempool like flashbots, which can reduce the front running but may lead to censorship or favoritism. Since it's no longer an open queue, service like flashbots or MEV blocker lets you submit transaction previously so bot can't see or reorder them in the public mempool. I know it's a bit more technical but very effective. Many sandwich attacks exploits high slippage settings on decentralized exchange. Set slippage tolerance as low as possible so you are less exposed to big prices movements within a single block. Platforms like 1inch or Matcha break your trade into multiple routes or split orders across with different exchanges. This makes it harder for the bots to predict and profit from large single trades. MEV actively spikes when network busy or during major announcements. If you can wait off peak hours to reduce the change of transaction being targeted. Some wallets have built-in MEV protection. Over time, you will see more user-friendly solutions that cloak your trades from malicious bot. So MEV is here to stay. It's woven into how Ethereum and other blockchains order transactions. Sometimes it's useful, like arbitrage, keeping price in check, but more often than not, it's regular users who pay the price. The good news is you can reduce your risk by using private transactions pool, limiting slippage, or relying on decentralized exchange aggregators. Understanding MEV also help you to navigate the DeFi world confidently and knowing how to avoid hidden bit. Thank you for watching.